Hello and welcome to this Forex Preview at xm.com. I'm Maria Battered, and joining me is investment analyst Cristina Parthenidu. We'll be discussing the EU PMI readings and the reaction in the euro market. So Cristina, we had several disappointing data releases out of Germany and also discouraging political developments in Italy, showing that the euro economy is heading in a difficult direction. So will flash PMI endorse that negative view?
Well, I think the latest data releases are more than convincing that the Eurozone is under pressure and well exposed to trade and Brexit uncertainty. We saw the German economy, which drives most of growth in the Eurozone, contracting in the second quarter because of falling exports and industrial production. And flash manufacturing PMI data on Thursday are expected to fall further, showing that the third quarter might be even weaker, as trade and Brexit uncertainty continue to weigh sharply on the business sentiment and probably on consumer spending if the services PMI fall further as well. So if the data continue to move downwards, the Eurozone might need stimulus from both the member states governments and the European Central Bank to avoid a recession in coming quarters, especially if Italy adds more pressure by approving a larger budget deficit for 2020 in September.
I see. Now, turning to the ECB, the word is out that the ECB is likely to deliver a larger stimulus package than initially planned. Do you think that this could happen at the next policy meeting in September?
Well, we have seen some central banks cutting rates more than expected, so we can't exclude the case. In the Eurozone, however, things are different. Interest rates are already negative, and a more aggressive rate cut could further squeeze profits in the banking sector that are already against those rates. So I think the ECB in September might follow expectations and deliver a 10 percentage points rate cut. Of course, the central bank has another option to deliver a larger new asset purchases program to raise liquidity. But this might not be easy as it sounds, because government bonds in key economies such as Germany and France have already negative yields, and buying those assets wouldn't be very efficient. Moreover, based on regulation, the ECB is not allowed to hold more than a third of government debts. Based on these restrictions, the European Central Bank might take some time to consider to deliver a larger stimulus package.
Okay, right. And finally, looking at the euro, could we see more selling?
So the outlook for the Eurozone and therefore for the euro is quite bleak at the moment, and disappointing PMI data may add more to the negative sentiment, sending the euro lower. But whether the selling in the euro may persist as we move ahead in the week will depend on the Fed's Jackson Hole annual symposium on Friday and later on the G7 meeting. So if, for example, the Fed set the stage for a sharper rate cut in coming months, then the euro might reverse the losses on the back of a weaker dollar. Also, positive trade discussions in the G7 meeting could also support the euro, but overall the impact will depend which of those currencies will gain or lose the most from the upcoming events.
Cristina, thanks so much for joining me, and thanks for watching at xm.com.